Welcome to Offshoot, the Fident Capital podcast with host Kevin Choquette. Offshoot is a curiosity-driven conversation that features a wide range of real estate and business professionals. In each episode, we unpack the knowledge, vantage point, and domain expertise of our guests. Then we move beyond the facts and figures and dive into the personal habits and mindset which allow them to be high performers in their respective field. This podcast's objective is simple: supporting entrepreneurs, fostering relationships, and uncovering meaningful conversations that positively impact business.
Welcome, everyone, to episode 20 of Offshoot. Today, Leo Simpser, founder and head of LLJ Ventures, joins me on the podcast. LLJ is a private equity firm focused on real estate that Leo started in 2008. Their 8-person SWAT team, my term, not theirs, packs a hell of a punch. As part of 3 affiliated companies, LM Capital, LM Advisors, and LLJ Ventures, they manage a collective $8 billion of high net worth and institutional capital. LLJ has provided their investors a 24% IRR and 2.3x multiple since their 2008 inception. Though they run $1 billion to $2 billion of capital, they are boutique and bespoke by design. They employ one-off investment structures, not funds, and pursue an opportunistic investment strategy to find attractive risk-adjusted returns. Leo has a lot to say and spends a good bit of time setting the stage to LLG's success by sharing his experience starting and then failing with Hinnie Mae, a private company that extended residential purchase mortgages to underserved Hispanic borrowers. Through all of it, I hear someone who's attuned to the macro and the micro. He has what Jim Collins describes as zoom in, zoom out. He's got a clear sense of doing right by the community and bringing that purpose to his day, but he also knows that nuance matters. As just one example, I mentioned how one of their incentive structures sounded like it could be tax efficient for employees. Rather than simply saying, yes, Leo says something like, well, tax is complicated, but it might be more efficient. That intellectual rigor and his ability to assimilate big thinking with the minutiae of day-to-day execution strikes me as a central component of LLJ's success. Listen in as we cover topics that include failure as part of the entrepreneur's journey, and how our reaction to failure is what helps us learn who we really are. The value of taking a break from the day-to-day, where distress exists within today's marketplace, the pitfalls of investing into funds and the fund structure, how the quality of money, namely institutional versus private, can inform investment decisions and investment vehicles, creating unique custom investment structures like deals with zero preferred return, why you pay for local expertise in an operating partner, co-GP investing and how LLJ might take as much as 97% of the equity in a deal, how to match the portfolio allocation needs of investors to the risk profiles of a deal, the trade-offs associated with being opportunistic, namely picking up flexibility to chase returns, but giving up domain expertise and some of the efficiency associated with executing in a single vertical. First the partner, then the deal. Being relationship-oriented versus transactional and making money for your investors. Creating the opportunity for long-term employees to become wealthy as part of the team. Giving back in the form of interest-free loans. Saying no. And executing on what calls you to action as an entrepreneur, as we only get to go this way once. I hope you enjoy the episode. Leo, thank you for taking the time to join me on the podcast today. I appreciate it.
Of course, it's my pleasure, Kevin. Thank you for having me.
Yeah, I know you're very busy, and I appreciate you taking the time. To get us started, could you just tell us a little bit about yourself and perhaps LLJ?
Sure. So I was born and raised in Mexico City. Then I came to the U.S. for both my undergrad and grad degrees. And I founded LLJ in about 2008 during the great financial crisis. And LLJ is a private equity real estate firm that invests opportunistically in different asset classes and different parts of the capital stack.
And what are you guys seeing right now in the business? What are the opportunities and challenges you guys are looking at?
Well, the market is transitioning. It seems like interest rates went up very significantly, and both the cap rates and valuations have not necessarily adjusted fully to reflect this new interest rate environment. And basically, what we see is that people who do not need to transact, who do not need to sell, are not selling. They rather wait until interest rates come down and valuations go up a little bit. So there's not as much liquidity as there was before. And since we're opportunistic and always trying to find what the best risk reward strategies are, where the best combination of reward versus risk is in the market, we're seeing some good opportunities in the preferred or debt markets. In other words, we're able to come in with preferred equity or mezzanine debt and get equity-like returns without taking necessarily the equity-like risk. So we've been seeing some of those opportunities in the multifamily sector, which fundamentally is still very strong.
Yeah, and as I understand it, LLJ has a pretty significant portfolio also in multifamily. So how do you guys view, getting kind of a late deployment? I don't even know where we are in the cycle, but let's say we're late cycle or maybe we're early of the next cycle, but putting dollars out now might look different than the dollars you put out 3 or 4 years ago on, perhaps ground up developments and things like that. How do you guys kind of reconcile with those two competing realities in different vintages, if you will?
Yes, absolutely. So capital now has more value. There is more demand for capital than there was, more need for capital than there was before. And so you need to price it accordingly. You need to be very selective. Instead of, as I said, instead of going into, let's say, a brand new development right now, or buying an existing asset, you find a lot of very good developers, for example, that are in a little bit of a bind, either because construction costs were significantly higher than they had anticipated, so they had a cost overrun. It's not uncommon to see projects that came out of the ground 2-3 years ago to end up with significantly higher costs due to the inflation we've had, on the one hand. On the other hand, their financing costs, if they didn't have a fixed rate, which is not uncommon during construction to have variable rate, their interest costs were significantly higher too. And lastly, even though rents also went up, currently, when you look at the refinancing market, after people build and are trying to put on permanent financing, they're seeing that the amount in the new loan, that the proceeds are not necessarily sufficient to cover their existing loan slash pref or loan slash mezz, or simply their senior loan. And as a result of that, they either need to come up with more equity or they need to, or they're going to lose their project. And sometimes they don't have enough equity to put down. And that offers a great entry point or an opportunity for someone like us that can deploy fresh capital and be in a preferred position above their equity.
Mm-hmm.
That's one of the areas of opportunities we've seen. So you have certificate of occupancy, the property is complete. It might be leasing, or it might be stabilized, and the sponsor, the owner, the developer does not have enough money to refinance the senior loan, and the senior loan is not, the senior lender maybe is not as flexible as they would have expected. And this has to do also with the context of the consequences of the increasing interest rates and what happened with the regional banks. A lot of banks are under more scrutiny And, if they lend into other sectors that are going through tough times, let's say they lent into office and they're having to take significant write-downs, and so on and so forth, they really want to get repaid, and they don't necessarily have the flexibility to work with the borrower as much as they did before. So that's one set of opportunities. The other one is people who, as I said, ended up with significantly higher costs than anticipated, and they can't, they don't have enough money to finalize their project. Maybe they're 85% complete, and they still need a little bit of money to get the project done. They may go to their construction lender and say, hey, can you give me a little bit more proceeds? We're all better off if we finish this building. If I leave you with an 85% complete building, what are you going to do with it? And again, some of the lenders are not in a position to be flexible and give them more proceeds for a variety of reasons. And that presents another opportunity for us to come in with a structure where their equity is subordinated to ours, and then we can give them money to finish the building and have a lot of downside protection.
Mm-hmm.
Those are some opportunities.
We can get into kind of the structural stuff on that, but it's probably worth also going back to kind of more story of origin of LLJ, which I'll get to. But when you guys, you're speaking to that opportunity with a lot of fluidity, and my suspicion is you may also have projects where you're of similar vintage. Maybe it was a 2020 or 2019 apartment construction start, and you guys are coming out with your partners into that permanent financing market and finding the same sort of constraints. How does it look from the other side for deals that you might have been principally invested in that are weathering the very same constraints you just articulated, whether it's the cost overruns or coming up short on loan proceeds from the permanent market?
Sure. It's a very good question. We actually do have some projects under construction. First of all, we try to be disciplined and didn't necessarily chase the yield like other people were doing or like the market was doing. So we would only look at projects with a significantly higher yield to cost than what the market was trading at. So, for example, if people were doing deals that in Excel were solving for a 5% yield on cost,
Mm-hmm.
we were not doing those. We were trying to, we were passing on most deals, and we were only trying to do those deals that gave us something closer to a 6. And so it was difficult because we didn't deploy a lot of capital, and we needed to wait for very, very punctual and specific opportunities. So we are finishing up a project in Lemon Grove, 66 units. It did cost a little bit more than we had anticipated, mainly due to delays. And the delays were related for the most part, to a significant rainy season in San Diego in a period of time during the construction where it really affected us. And so, of course, when a project takes longer, it costs more. And we also had an unfortunate event with one of the subcontractors. But what we are, because we were a little bit more conservative going in, the increase in rents is basically making the project still be very attractive. The only thing we had to do was to put in a little bit more money into the project. And the way we did that was by splitting it with investors. In other words, the LPs put in half of the money that was needed, and the sponsors lent the remainder money at a relatively low rate. And in that way, we were able to ensure that the new money coming into the deal had at least the same returns, if not better returns, than the initial money that came in. So not very significant because we underwrote conservatively. Yes, we're facing the same issues. And now we can actually refinance 100% of the construction loan and the additional loan that we made. So we're going to stabilize this project, and we'll be in the market probably towards the end of the summer, end of the year. And I don't foresee any difficulties. Multiple other projects that we have in terms of development, we always try to, when we buy land and where we're entitling land, our rule is never to put on debt. And as a result of that, those projects, we have enough capital to entitle them. If they're entitled, we put them on hold. And because we don't owe any money to the banks, we don't have any pressure. And we're only going to start when the numbers make sense. So thankfully, our portfolio is relatively healthy. And I guess it's partly luck, but for the most part, it's discipline.
Yeah, mitigating that tail risk. Well, look, let's go back. We kind of got started going right into the tactical. You started LLJ 2008. What brought you to LLJ? And I know LLJ operates within an ecosystem of a couple other asset managers. Maybe you could get into that a little bit so people can kind of contextualize the specifics of these deals.
Absolutely. I think it's better to start with the background. So I'll give you a little bit of background of pre-LLJ, because that leads me to how I started the company.
Yeah, great.
So before the great financial crisis, before 2007, I was one of the founders of a company called HNMA, the Hispanic National Mortgage Association. My partner and I, he identified a market opportunity where Hispanics and other immigrants had significantly lower homeownership rates than the rest of the market. And once you analyze that, you could conclude that it was not due to differences in income and education. In other words, even though there were differences in income and education, and those justified some of the home ownership gap, there was something else going on. And I understood it very clearly because I was an immigrant. I am an immigrant myself. And so when I came to the US, I couldn't get a Macy's credit card, even though I had enough money to pay it out. I was simply not entering the credit system the way everybody else had. And so you had Fannie Mae and Freddie Mac, who were at that point government-sponsored enterprises. And they basically had an advantage relative to the rest of the financial institutions because the Congress created them, and Congress basically gave them an implicit government guarantee. So they could borrow at a lower cost than anyone else. And nevertheless, they were privately held institutions. You could buy their stock in the stock market. And so they always had a conflict, right? On the one hand, their government sponsorship is what allowed them to make significant amounts of money. But on the other hand, their incentive was to maximize shareholder value. And so they weren't really serving a social good, even though they spent a lot of money, time, and effort justifying that they're helping minorities and they're helping home ownership rates and so on and so forth, because that PR justified them having this implicit guarantee. And when I came in and studied the problem carefully, I saw that back in time, Fannie Mae's average FICO score in their books was over 700. So they had very, very high credit. They didn't take on a lot of credit risk, and they didn't really expand homeownership too much. Even though they did have some efforts, they were minuscule relative to their size. But they made a lot of noise about them because they knew that was what justified them having this unfair advantage. And so I came into the market and realized that the problem was credit. The reason why Hispanics and other immigrants had significantly lower home ownership rates than the rest of the market after you adjusted for income, education, and other aspects, was because they didn't qualify necessarily for the mortgage, which is obviously essential in buying your first home in at least in the US market. And so I understood it very clearly. And there were a lot of cultural aspects and practical aspects. I'll give you a few examples. From my father told me you can buy whatever car you want as long as you can afford it, meaning you buy the entire car.
You write the check.
Yeah, you write the check, and that's what you do. And in the US system, it's all about whether or not you can afford the monthly payment, right?
Yep.
So that's one example. Another example is just the heavy reliance on credit. Hispanics tended at that point in time to have significantly lower use of credit cards and significantly lower number of credit cards, because the credit card was seen more of an emergency type of financing than just carry balances in your credit cards. And if you think about it carefully, your FICO score was lower if you only had one credit card and you rarely used it than if you had multiple credit cards.
Yep.
Because in the FICO world, having multiple credit cards gave you a lot of points of, oh, this guy, or this girl really knows how to manage credit properly, because they have 20 credit cards and look, they pay them all, and they have balances, but they make their minimum payments and so on and so forth. What do you think happens when somebody gets laid off and has 20 credit cards versus a guy that has one credit card? How much more dangerous is having 20 credit cards if you have no income, right? From a credit perspective. I'll give you the last example. I mean, job stability. At that point in time, of course, they're trying to qualify you for a mortgage, and they look at your job stability. So you have a person that has been working in Detroit in GM building cars for 25 years, and that's considered very stable. And then you have this Hispanic person, cleaning toilets 1 year, and then the next year he was a waiter, and then the following year he was working in a hotel, and so on and so forth. And that was seen as very unstable, right? Look at this guy. He's jumping from one job to another every year. Guess what? That person was increasing their earnings every year on the one hand. And on the other hand, he showed a bunch of flexibility, which and honestly, also resilience. If he gets fired from one, he'll go back and clean toilets. He'll do whatever it is necessary to maintain his or her income. And as a result of that, these patterns that you saw affected people negatively, even though it didn't necessarily mean that they were higher risk. And so what you saw in the subprime market is that, if you think about it graphically, the Hispanic borrower was a square peg, and they were trying to fit in a round hole, and it didn't fit, right? So what subprime did was make the hole so big that even though the peg was square, it would go through. So you had a bunch of Hispanics and other immigrants that were going into the subprime market, paying very high rates where they were not necessarily higher risk. And so what we tried to do, my partner raised the money and I ran the business, and I decided to focus on credit. So I hired a bunch of PhDs, and we created this company. And when I went to the large banks and tried to get them to work with us, they were keen on attacking the Hispanic market. And they were just saying, yeah, just bring me data. And if you bring me enough data, we'll, of course, partner with you, and we'll do more mortgages to the Hispanic market. And I had to explain to them, you know why there's no data? No. Why? Because you don't lend to them, and you don't know. You know why you don't lend to them? Yes, because there's no data.
There's no data. Yeah.
So, do you see the irony there? How can you innovate in the mortgage market, which is a huge market, if it's all based on data, and you have basically left out a significant portion of the market, not with intention, but that's just the way it was. So it was very difficult. And then at that point, I realized and understood that even the large banks, and I'm talking Wells Fargo and, some of the largest banks, they were not really making the decisions as to whether or not to lend to people. The people making the decisions were the ones buying the mortgages from them. And so even if Wells Fargo knew that a mortgage wasn't very high quality, all they care about is that they could originate at 100 and sell it in the secondary market very quickly for 102. And that is the genesis of the financial crisis, right? The different incentives that people had, and the banks were originating garbage. And as we were originating, we were very loose on certain criteria, but very tight on other criteria. And I saw the evolution of the market where they became loose everywhere. You had ninja loans, no income, no job, no assets, no assets, Nina loans, no income, no assets. And, those loans were being sold in the secondary market. So even though Wells was very well aware that, those might never get repaid, who cares? It's not their balance sheet. Let me just resell them. And as long as home prices continue going up, nobody's going to default, because if you get into trouble, you just sell your home and you pay off.
And there's another loan right behind it.
Yeah, and there's another loan right behind it. So I didn't mean to get into so much detail, but this is very important, both at a personal level and a professional level. We were doing really well. At the end, I was able to do a joint venture. I used to work for Deutsche Bank. They gave me $500 million line of credit, and we were basically being that secondary market. As I told you, I understood the golden rule, the one with the gold rules. So the person buying the mortgages was the person saying, this is a way you have to underwrite, and these are the mortgages that I'm going to buy. So we became a secondary market player where we went to banks and said, look, if you originate to my standards using my model, I will buy those loans. And they were very happy, and we were starting to do really well. And we had several hundreds of several $100 million originated, and we were going to go to the secondary market to sell those loans and churn that line of credit again and continue originating. And the crisis of 2007, 2008 came, and of course it froze the markets for securitizing mortgages. And as a result of that, the business failed. And it was very interesting because honestly, it was my first failure, and it made me grow very significantly at a personal level. I first was very disturbed, and I viewed it as a huge personal failure. I lost money for investors. The business failed. I spent, 5 years of my life working extremely hard, and it all came to a screeching halt. And I was not able to initially differentiate between my personal failure and the failure of the business. And so that was the first lesson. Trying to understand that I did great things. We innovated. We were a fintech before the fintech term existed. We were innovating. We were putting people in homes. The mortgages actually performed extremely well, even after the crisis. So our thesis was right. I did a joint venture with Wells Fargo, one of the leading companies in this space. I did a joint venture with Deutsche Bank. There were a lot of things to celebrate. However, I only saw failure. And I was subsequently, with time and perspective, able to differentiate between the failure of the business and my personal failure. And number two, I thought that the failure would define me. That's you invest so much into your companies, into your entrepreneurial endeavors, that you become one with them. They are you, you are them. They're your baby. They reflect you. They have your values, and so on and so forth. And I thought that I would be defined by that failure because my identity was so intertwined with that venture, if that makes sense. And so I was able to understand that, the failure was not going to define me, but how I reacted to that failure would. And so I became very conscious about, okay, how am I going to react? So what do I have in my current business? So I have investors, I have employees, I have suppliers. How am I going to react with them? Is really going to tell who I am, right? So I was able to place 100% of my employees with different firms, different opportunities. I worked really hard on that, and several of those are back with me now. After I got stabilized again, I was able to hire them back. We try to pay every last penny of what we owe to suppliers, or we arrived at consensual agreements. And we try to be very transparent with our investors. And, we accepted our mistakes, and we were able to continue keeping trusting relations with those same investors. For the most part, I would say 90% of the investors are investors that continue investing with us in spite of the fact that we lost money in that venture.
What was the timeline? When did you start Henny May, and then when did that it imploded? Like 07, 08? What was the?
Yeah, it imploded in 08, 09. 08,
Okay.
09, yeah, 08 essentially. And I had been working on that for at least 5 years, so maybe 2004 to 2008, 9. That was
Okay.
more or less the period. So that takes me to how I started LJ Ventures. So at that point in time, interestingly, I didn't have a lot of time to stop and get all depressed and take a lot of time off, because I had 2 kids and 2 on the way. My
Oh, wow.
wife was pregnant with twins, and that keeps a lot of pressure. So yes, of course, I was sad and maybe somewhat depressed for a few weeks, but I really had that pressure and that incentive. And I had an opportunity for the first time in a long time to step out of the day-to-day and say, what is my next step? And how am I going to be defined? What did I learn from this failure? And how can I use it for my next endeavor? So I had a real estate background from a family perspective, on the one hand. On the other hand, I really understood what was going on in the mortgage space and how lenders were lending and their situation and so on and so forth. And I said, you know what? I'm going to take advantage of what actually killed my company and use it to my advantage. The knowledge that I have, the contacts that I have, and I had a thesis that the crisis was gonna end at some point, and that their markets tend to overreact when there are crises, and that there were going to be a ton of opportunities. So I said, you know what, I'm going to start buying both mortgages and real estate opportunistically, and that's what I'm going to do. And I'm not going to tell you that I wasn't afraid, because the crisis was ongoing. If you remember, I mean, it didn't finish in 2008 or 2009. The real estate values were still going down dramatically. And so we started doing that. So I created LJ Ventures, and I told my partner, hey, I'm not going to let you or the investors hanging. I'm going to start this thing. And we ended up doing a deal where we partnered in LLJ Ventures, and I partnered in the business that he had started multiple years ago. He started in the 80s, a wealth management firm, and he did the tough part. He started from zero to about $500 million in assets under management. And so I basically partnered with him. I wrote a business plan where I wanted to modernize that business. And I said, look, it's your business. This is the business plan that I would like to execute. If you agree, we can partner. If you don't, it's 100% your business. You can do whatever you want. And he said, no, yeah, let's do it. And so we partnered both on the wealth management side and in LJ Ventures. Let me tell you about the design of LJ Ventures early on, or philosophically how I set it up. So first of all, I decided not to do a fund. I don't love investing in funds myself. I like investing in specific opportunities. So there was a little bias there. But the main reason was I wanted to be opportunistic. There was a crisis unfolding. Nobody knew exactly what was going to happen with the different sectors of real estate, and there was a lot of uncertainty. And I did not want to be tied to a box and still be opportunistic, because if you're tied to a box, let's say, one of my first investment theses was to invest in limited service hotels in secondary or tertiary markets. And if I had raised a fund to do just that, I would have been stuck in that. And if the opportunity didn't materialize there or shifted, I wouldn't have been able to deploy that money. And as a result, I didn't want to have that box. So that's number one. Number two, incentives. I'm all about incentives. A lot of the funds have a life, most funds have a life, have an expectation of timing. So maybe it's 5 years, maybe it's 6 years, maybe it's 7 years. But at the end of those 7 years, they need to sell. And it might not be the best time to sell real estate. Real estate is relatively cyclical. You have highs and have ups and downs. And if you, by mandate, are forced to sell during a bad market, you're not going to do well. And so I hate that incentive. Conversely, if you have a fund and you have a lot of money and the market is super expensive, you need to deploy it. So I don't like that pressure. And I'm not criticizing managers who live in that space. I think, as long as you do better than your competitors, you're okay. But since I was investing my money and my clients' money, and my clients are friends and family, and they're close people, and I care a lot about their money. These are not faithless investors. They're not, big institutions who have maybe different incentives relative to the way they manage the money. I need to look at people in their face. And I know them, and I view it as my own money. And so I don't always want to be invested. I want to be invested when things are cheap, and I want to be more conservative when things are expensive. And so having a fund might screw up the incentives. Lastly, I didn't necessarily want to be tied to a particular part of the capital stack. So if you want to do equity, that's great. If you want to do debt, maybe that's a great opportunity too. Or if you want to do preferred equity, as we started chatting about. And I don't need to stick to only one portion of the capital stack. I can be flexible and try to understand where the opportunities are, and then move accordingly. So, and the last piece is I always want my investors to. Well, I'll tell you two more things. So one, my investors, here's a specific opportunity. Do you like it? Do you not like it? If you don't like it, don't come in. If you like it, please come in. If you have a fund and you make a big mistake on a particular property, investors can say, oh, I wouldn't have done this or that. In this way, I am upfront with them. I tell them exactly what the risks are, and they take the journey with us. And the last thing that's very important is incentives. A lot of the times when you have a fund, you have a fixed compensation structure. Let's say you have a carried interest and a preferred return, and so on and so forth. And I think it's for the most part great. And for the most part, it may align the interest of investors and managers, but sometimes it doesn't. And you have certain deals where you shouldn't have a high preferred return. If you do, as a sponsor, you're incented to maybe sell very quickly. And do a high IRR, as opposed to really think about this investment as if it were your own money and go for a large multiple. And so I think that each deal requires a different structure of compensation to the sponsors or to the managers, so that it's congruent with the business plan. And so that's the other reason why I set up LLJ the way I set it up.
Quick question on that.
Yes, go ahead.
Going back to Henny May, the investors, the macro overshadowing your execution. Some of your investors sounds like not necessarily being made whole, but you keeping those relationships intact. Are those some or all of the same investors that have come with you to start LLJ back in 2008?
Absolutely. There's some. They're not all of them, but. First of all, let me make it clear: we lost all the money.
Okay.
Yeah, this was a startup, and it was an innovation. It was innovative, and they lost 100% of the money. And for the most part, as I said, people did not lose the faith in us or the trust in us. and they continued investing with us.
Well, and you stated, is it Louis or Louis? Like your
My partner is Luis Maisel. Yes.
yeah, Luis. So you said Luis had gone from 0 to 500 million. I don't know how up to date the current website is, but maybe 7 billion at this point.
Well, there's different businesses. So LM Advisors is an RIA, registered investment advisor. We're regulated by the SEC, and we manage money for high net worth individuals. That business was started by Luis in the 80s. And when I joined, it had about $550 million under management. And now we have we have a little bit over $2 billion under management.
Okay.
LLJ Ventures started from zero, and our current portfolio is worth in excess of $1 billion, but it was probably closer to $2 billion at some point. But we were net sellers during the last years. And then there's another business that's related, but I'm not a partner in. That's Luis and other partners called LM Capital, and they manage, I believe, over $5 billion. So the whole group, we probably manage about $8 billion or so currently. But LM Advisors manages $2 billion in public markets, and LJ Ventures has a portfolio of around $1 billion, but it fluctuates.
Okay. So how do you think about starting zero, getting to 2 billion, now you're back down at $1 billion as a net seller, taking the RIA, sort of a high net worth management business from 500 million to 2 billion. I mean, those are all since, call it 08, 09. That's pretty significant growth. What are you guys attributing success to at this point?
So let's say divided, on the real estate side and on the wealth management side. On the wealth management side, we have a great team and we have a very good name. And in reality, as I said, the hard work is going from 0 to 500. Once you're at 500 and you have a bunch of happy customers for a number of years, they start referring people to you. And so we believe in always putting the client at the center of what we do, both on the wealth management side and on the real estate side. We don't look at these as transactions. We look at these things as relationships. And that's part of the philosophy in LLJ Ventures. Our fee schedule is not very high. I can tell you that we lose money if we only get our fees. We make our money through our own investment and through our carried interest. So if the clients are successful, if the investors are successful, we're very successful. But if a deal goes south or it's mediocre, we don't make any money with the fees. Why? Because we're aligned with our investors. These are long-term investors, and if they make money here, the money is going to go back to the wealth management side, or it's going to go back into another deal for the most part. So I attribute the growth in part to treating always investors in the right way, being transparent, always trying to do the right thing for them, even if it's not the most profitable for us. So on the wealth management side, there's multiple business models. Our business model is we only take a fee of assets under management from the actual clients. We don't take money from hedge funds or retrocessions. We don't take money from banks. We are not a broker dealer, even though we could be super profitable, but we would have a conflict of interest with our investors. And other competitors are broker dealers, and they make money when they're trading. And we believe that presents a conflict of interest, and for basically incents people to trade more and to have much more activity, and is not necessarily growing the assets of the client. And so that's one of the key things. And the second is performance. We've had good performance, both in the public markets and in the private markets on the real estate side. We have done probably 80 transactions on the real estate side since 2008 or so. Unfortunately, we have lost money on 3 of them. But even after taking that into account, our track record, our IRRs are in the high 20s, and our multiples are exceeding 2 times in the high twos from a historical record perspective. So we have very strong performance, and we try to treat clients right. And I think if you do that, assets will follow.
So the treatment you gave there of funds, I'll tell you that I also align with. Go through the hypothetical of, okay, we're going to raise $500 million. It's a 5 to 7 year fund. We're going to take 2 points of asset under management. Maybe it's an 8% preferred return to the investors. After you get your 8, we'll do a catch up and then take 20% of the overall funds project or funds profitability as the asset manager, which means you're crossed into a bunch of deals that you don't control. You are going to see forced liquidations. They're going to go, well, look, it's year 7, it's year 8 of this fund. We really need to sell that asset, even though the market's bad, so we can catch our promote and wind up this fund. I understand all of the negatives that you're articulating. I think I got a lot of how you designed around that to kind of fix those problems, but without getting, sort of into giving the keys to the kingdom away, how much variability do you guys put into different deals based on, this is a 3-year deal, this might be a 10-year deal. This kind of goes into your strategy of being opportunistic as well, because I know you'll do core investments, you'll do value add investments, you'll do opportunistic investments. How do you think about changing the single deal structure between you and an investor as each unique opportunity comes up relative to those fund structures that we're just talking about?
Sure. So we do change it a lot. The answer is there's a huge variability. I'll give you extreme examples. If we are in a very long, we bought a land in Warner Center, 26 acres. It had office in it, low density office. Imagine, 1-story buildings. And we knew that there was a plan in Warner Center, a specific plan that wanted to build more housing. This is a long time ago, 2012, 2013. And we wanted to buy these offices, but we saw them as a parking lot, right? We wanted to re-entitle it and then potentially redevelop it or sell it. Once we were able to add value. And even though there was a specific plan, which got approved very quickly after we purchased the property, I knew that we were dealing with the city of LA. And I knew that they were very slow and very bureaucratic and very difficult to deal with from a development perspective. So I also knew that this location was extraordinary and that we wanted to do a long-term hold. So I sat down with the main investors and I said, guys, if you agree that this is a very long-term hold and that there might be significant delays and so on and so forth, I don't want to have a high preferred return. Because if I do, then we're going to buy it, we're going to add a little bit of value, we're going to sell it, we're going to do a huge IRR, and you're not going to make a lot of multiple on your money. And I'm going to put my own money, and I want to make a big multiple on my money, and I want to have a long-term hold here. So we ended up settling, and I negotiate against myself as well, because I want to do what's best for investors. And we ended up with a 1.8% preferred return, for example.
Wow.
Treasuries were at 1.8%, and that's what we did. Now, of course, our upside was also somewhat curtailed, and we did a funky structure. So that's one example. Another example, we bought a piece of land, very cheap, no debt. The idea was to hold it, and we said 0% preferred return, and we have 20% of the upside up to a certain multiple, and a slightly higher after that multiple is very high, say 4 times your money or something like that. And if you're going to hold land long term and you have a preferred return, how can you really optimize your decisions, right? You get a quick offer that is a couple $1,000,000 higher, or that is going to give you a good IRR, and you're going to sell it, where you have very valuable merchandise. And if it's not in this cycle, we can wait 3 or 4 years. And so that's one extreme. Another extreme is we're buying. We bought some of the first deals we did. Even though I said I wanted to buy hotels, I couldn't. The sellers of the hotels wanted a higher price, and I wanted a lower price. And the bid-ask spread in the market was too wide because there was a crisis and a lot of noise and uncertainty and so on and so forth. So I started buying notes with hotels behind them, right? And so when I was doing those notes, it was more of a quick type of deal where we, depending on what happened, we could have a relatively quick exit and a relatively quick IRR. And so we had a completely different structure there, if that makes sense.
It does. I think that we'll probably talk about alignment of incentives as we talk about your team as well. But one thing I'm struck with, if you guys are, say you have $1 billion currently deployed in the LLJ platform, if somebody like me comes forward with an opportunity and, hey, it's a $19 million LP check, obviously there's some discussions. You have to figure out if you like the sponsor, the market, the deal, the overall deal structure. But how do you, in this, construct that you've just outlined, get your investors to move quickly enough to subscribe, say, a $19 million LP check in the timeline that the marketplace would expect, which was, you say LLJ offers a term sheet, my client signs it, and we fund 60 days later? It seems like that could be challenging.
It could, and it's typically challenging to most syndicators. But remember, we have the privilege of also owning and running a wealth management firm where we have a bunch of high net worth individuals. And historically, we've had much more appetite from them to do deals than we have deals. So that gives us the luxury of being able to behave like a fund, like you just said. We signed a term sheet and we can close within 60 days with no problem. We try to do only deals that we consider really good. So we basically negotiate everything, and then we write a memo and we send it to our investors, and it's first come, first serve. And so far, we've been able to always fulfill our commitments. Now, is there a limit? I'm sure there is. We've done deals from, we typically don't do deals where equity is below $5 million, but we have when the multiple is very high. Maybe I'm just a sucker for good deals. I mean, if I find a good deal, I start salivating, and that's my instinct is, I'm an investor, and I get a thrill out of thinking that I'm making a good investment, and I love that process. But we've also done, we have a deal with $35 million in equity. With this particular deal that I was talking about in Warner Center, we put in $30 million of equity. So we've also been able to do those checks. Now, if I have several $30 million deals in the same year, are my existing investors going to, feel that? Maybe not. I mean, I'm sure there's a limit, but so far we have more demand from investors than opportunities, and that's a function of us being selective and the size of deal that we're playing in. We try to be larger than what typical high net worth individuals would do on their own in terms of deal size, and we try to be lower than what institutional investors would do. And, in between, let's say, $8 to $15, $16 million is a sweet spot where there might not be as much competition from institutional guys, and there might not be as much competition from high net worth individuals.
Yeah, that makes sense. So let's talk about, I heard everything you just said in terms of the investors having more appetite than what you typically are providing them. What's curious to me, and this also stands in contrast to the fund or a fund strategy, is that LLJ invests across the spectrum in terms of core, value add, and opportunistic. How do you guys think about being an opportunistic investor and being flexible enough to say, hey, this is a really attractive core plus return, even though that's maybe a high single digit return, versus you just mentioned something where, above a 4x multiple, we would get a greater promote. How do you think about operating in that space? And I guess secondarily, how you also find that the capital will take an attractive 9 and also go after a 4x deal?
Yes, absolutely. It's a very good question. First of all, the one thing that is not going to change at LLJ is looking for good risk-adjusted returns. So is a good, when I ask people, is 12% a good return? And they say yes or no, or is 20% a good return? That's the incorrect answer. The answer is it depends on the risk, right?
Mm-hmm.
So that's how we're wired. Finding good risk-adjusted returns, number one. Number two, if you remember, I also am very involved in the running of the wealth management platform, specifically on the investment side. And so being aware of public markets, valuations, REIT valuations, interest rates, interest rate volatility, so on and so forth, allows me to have a relatively good perspective on relative values, right? So what are things trading for in the public markets? What are things trading for in the private markets? When is one thing more interesting than the other? And that allows me to also, I think, have a good perspective as to what asset class seems to be more attractive at this particular point in time. Now, you didn't ask that question, and I'm not trying to avoid the question. I think it's just a prelude to say, first of all, we need to be convinced where the best risk-adjusted returns are. And let's say at one point in time, they are in core plus, or at another point in time, they're opportunistic. And once we're convinced that we have a very interesting relationship between risk and reward, then we go to the appropriate set of investors. We try to choose our investors according to the business plan. Some investors are not interested in a 10-year hold, right? They might maybe older and they're not interested in that. Some investors are looking for cash flow. So if you put them into a deal that has no cash flow, even though it has a lot of appreciation, they're not going to be happy. It's not going to be a good fit. So the beauty of doing deal by deal basis is that you can put the right set of investors in each individual deal. So you align the capital with the business plan. And that's essentially what we do. We do tend to look for relatively attractive returns. So when you mention 9%, I don't think we've ever done a deal at 9%. Maybe we've done deals at 10%, but those are loans in a senior position with very, very good collateral. And we just had a context or a specific opportunity where we were able to lend super expensively. But other than that, we try to shoot for larger returns.
Sure, but I know just from kind of recently browsing the website and exchanges I've had with you over the years that value add deals are very much in the strike zone. I believe you'll take on a land entitlement deal under the right structure. Certainly, you guys go vertical, so you do deploy across that risk spectrum. How
Yes.
do you think about? I mean, I hear what you're saying, right? We want an appropriate risk-adjusted return for whichever portion of risk we're biting off. But that also it has the risk, I would say, of diluting your efforts because you're not a single
Yes.
focus. You're not just, hey,
Yes.
we are a multifamily developer.
Yes, you are absolutely right. There is a trade-off. And I'll give you a few of the, it's a very, very good point. So on the plus side, you have flexibility, right? On the negative side is you can't be an expert at everything. We recognize that, right? While we have a lot of experience in multifamily, we don't have a lot of experience in self-storage.
Mm-hmm.
And while we know the San Diego market really well, we don't know doesn't matter, the Iowa market really well. And as a result of that, and recognizing that we're not experts at everything, and that even though we can measure the risk and reward of things, when it comes to execution, you really need to be an expert in what you're doing, It's a super competitive market. And so what we do is we partner in about 50% of our deals. If I check the data, maybe it's even 60% of our deals. So we execute deals on our own, those in which we have expertise, those in which we know the markets well, and so on and so forth. And we always partner when we don't have the expertise of the sub-asset class or the market. And even if we know the asset class and a good group that we like to partner with brings a good investment, we rather share or promote and provide the opportunity to our investors to be in a good deal, right? That's a long game. If I'm just worried, if I just start thinking, well, if I do deals on my own, I get 100%. And if I partner with people, I'll just get 50%, as an example. I'm only going to do deals on my own, versus giving the opportunity to my investors to invest in great deals always and more deals. I think long-term, that's a better strategy. If you really have a long-term focus, you don't care about the short-term, whether you're making more money in one deal or another. What you care about is that your investors make money and we invest alongside them so that we make money ourselves. And so that's a little bit of the answer, is partnering to fill in the gaps of the lack of focus on the one hand. And on the other hand, yes, it is difficult for the team, and I drive them crazy sometimes, because, you don't have a very clear origination strategy. We drive brokers crazy. Brokers like to put you in a box. Oh, LLJ does this and doesn't do that. I have a deal for LLJ. You know what I mean?
Yep.
And so the way I try to describe it is, Kevin, would you put your money in this deal? Why do I say that? Because when you say you put your own money and you think about it, you're thinking about reward and risk. And so you say, yes, I would put my money in this deal. Okay, put it. Let's go. Let's do it. But it is a little bit challenging, because, let's say we only did land entitlement deals. We would be 24 hours of the day running around, looking for all the land, looking for all, the players, only talking to brokers that in a particular area. Let's say we only did San Diego entitlement deals. We would have a lot more focus. And so I do believe we're missing out on some deals by being opportunistic. We are also maybe a little bit inefficient as it relates to origination. And we are certainly not experts in everything, so we sometimes share our economics. And those are the trade-offs that we are prepared to do in order to be flexible, opportunistic, and be able to move as the market moves.
Yeah, but I also hear you saying, maybe not explicitly, there are areas that even that opportunistic umbrella isn't going to cover. Maybe you've done deals in Iowa, but it sounds like there are parts of the market, maybe it's data centers, maybe it's ground leases, I don't know, that
yes,
you probably have chosen just to leave alone. You have a lane that's fairly wide, but you're not boiling the ocean.
Yes, we're not boiling in the ocean. And if we were to transact in an area where we have no clue, we would only consider that with an incredible partner with domain expertise.
Right. So let's bridge in a little bit to the co-GP investing, which I know LLJ has done, and I'll try to break it down for listeners, right? Take a standard real estate deal. We've got our senior debt. If we're going to have a equity partnership, it's typically an LP partner who might put up 90% of the capital and a GP partner who's charged to execute the business plan, putting up a 10% co-invest, and subject to a bunch of performance hurdles. This is the alignment of incentives that you've been talking about in order to get paid well for executing the entire project. That's vanilla. I know LLJ has played in the space where you might partner with that 10% GP equity group, which is kind of what you're alluding to. And hey, there are certain deals in certain markets where there's a local expert who we can partner with that will get us into that marketplace. It might dilute our returns, but we're doing right by the investor by getting into a good deal. And we're picking up the local expertise we need in order to feel comfortable executing there. How do you guys think about being in a deal where there might be, conventional debt, a big check LP, and then LLJ along with a local operator?
Yes. So the first thing is trying to choose your partners correctly. First the partner, then the deal. We've made mistakes in the past relative to partnering with certain groups that we shouldn't have. And we've also thankfully made some great relationships. And so, as I said, we do partner when we need the expertise, either in asset class or market, but we also partner with good people who we can partner with on repeated occasions, even if we could do the deals on our own, because we value what they bring to the table. How do we look at these things? So, first of all, we have historically supported a lot of younger folks who are maybe worked for a big real estate firm. They're great. They're very smart. They're very ambitious. They don't necessarily have a lot of money or a lot of relationships to raise money or even to put the 10% co-invest. And so if we see the potential, we would be flexible and say, you know what, we will put part of the co-investment and just put a certain amount of money that is meaningful to you, even if it's maybe for market standards, nothing. And let's get aligned. And LLJ will bring 100% of the LP money and will bring part of the co-GP money. And we, depending on the situation, in the ideal world, we want that group to be able to execute the business plan. And we want, in the ideal world, for LLJ's job to be supervising and asset managing. That's the ideal world. Now, we do negotiate the right to step in and take 100% control because we're bringing essentially 90, 95%, 97% of the money. And so our investors don't care about who we partner with. They care about us. They're giving the money to us. And if the shit hits the fan, we need to be able to step in and take control of the situation and try to turn it around. And so philosophically, that's more or less how we partner. And we've had many partnerships where things go according to plan and LLJ is not involved in the day-to-day. We're involved on a monthly basis. We get transparency with information. We visit the property. If there's a renovation, we're there, so on and so forth. But we don't do much more than that, than asset manage. And unfortunately, we have also had situations where we've had to take over and change management companies and change people around, supervise more closely, put in more money, and so on and so forth.
Mm-hmm. Well, I'm going to transfer a little bit over to the people on your team, right? The LLJ team. I think about 8 people exclusively focused on LLJ. You're very keenly thoughtful of alignment of incentives. How are you getting that team to stick with you through what you just sort of self-confessed is at times an inefficient process, turning over a lot of stones, looking in different pockets of the real estate world with an opportunistic, slant? How are they aligned with you, with the investors to, go back to the very top here with Hinnie Mae and all of the big banks trading paper for a 102 or 103 fee with zero regard for how the deal actually comes out at the end. I can imagine certain people in certain positions on your team, if allowed to, might generate new deal flow, get a fee for putting the deal together when it closes, and then 6 or 7 years or more later, when it ends up being a capital loss, they've made their 103, 102, whatever it is, they've moved on somewhere else in their career. How do you think about alignment within your own team?
Absolutely. That's critical. First of all, I see the people that are at the higher levels as partners, and they are partners. So they share a piece of the carried interest. that we get. So that's number one. That's one of the incentive structure that allows them not only to make a salary but to create wealth. I'm hoping that long-term employee that contributes significantly to LLJ will have an opportunity to become wealthy. So that's number one. Number two, I also have a plan that some people get where if they invest in a particular deal, we lend them money to enhance that investment. So you're committing to me, I will commit to you. And, let's say you are, you're in a position where you can invest $15,000 in a deal, $10,000 in a deal, which might seem like an insignificant amount. But if we give you another $10,000 or $20,000 as a loan against your 10, suddenly you put in 10 and you have $20,000 or $30,000 working in the deal. If the deal does well and it doubles its money, then your return is enhanced very significantly. And that makes everyone be very aware of everything that's going on and try to help, even if you're in a different position than, let's say it's an asset management situation, an asset management issue, the acquisition guys is just as incented to help or to point out the opportunities and so on and so forth. So those are some of the, I guess, structures that we use to incentivize people.
Given the variability of deal structures that you've already outlined, I suspect the answer is it depends. But in a prototypical scenario, if you've, say, doubled the investment capital for a team member who maybe put in 10, the company's providing another 10, is there a preferred return or interest rate that accrues while those dollars are out working on behalf of, well, sort of it's on their behalf, but it's also been borrowed capital? I'm just curious about the deal structure there.
Yeah, I mean, with respect to employees, the minimum interest rate by law that they have to pay is what they pay, but they don't pay it current. So again, let's do a hypothetical example. $10,000 investment, we give them a $10,000 loan. So now they're 20. So their investment is worth 40 at the end of, let's say, 3 years, just to give you an example, or 4 years, right? Mm-hmm. So 40 obviously minus 10, that's 30, minus the cost of the capital. Let's say the minimum interest rate in that period was 3%. For, let's say, 3 years, it's nothing. I mean, or 4 years, what is that going to be? A couple $1,000. And so they end up making, they invested 10 and they end up making their 10 plus another 18, so they triple their money.
Yeah, it's huge.
Yeah. And so even though it's a relatively small amount, I mean, we have limits. So we sit down, and the other thing we do is it's a little bit of a funky structure, but I'll try to explain it easily. So you have an end of year bonus, and you can either decide to take it in cash or you can invest it in different deals. So if you don't need to take it in cash, let's call it a savings account. You have that savings account, and you can decide to deploy it in any particular deal.
Oh, that's cool.
Yeah, instead of taking cash compensation, you actually get an opportunity to have that savings box and use it in the next deal, or
and much more tax efficient.
Sure, I mean tax is complicated, but there might be ways in which that becomes more tax efficient.
Right. All right. Well, let's switch to the personal. Thank you for getting so granular in all the technical stuff there. It's super insightful. I know you have ways that you like to give back to the community and share some of what has come your way. What avenues of service, if you will, have you found are meaningful, and how do you like to give back?
Yes, absolutely. That's one of my key drivers and motivators to keep on working aggressively and making money, to have big and strong impact in my life while I'm here. I do believe that my business failure that I discussed a little bit with you also gave me perspective. And prior to that failure, I didn't really have any failures before that. And I think I was too arrogant and too arrogant, and attributed most of the success I had thus far to myself, as opposed to understanding the element of luck involved in being successful. And as a result of that, I do feel that if I do well, I definitely have a responsibility for trying to help others that didn't have the same luck that I had. The fact that I recovered relatively quickly and very successfully after that crisis is a lot of it has to do with luck. Yes, a lot of hard work. Yes, a lot of strategy. But with a lot of hard work and a lot of strategy and bad luck, I would be at zero. And so you have to attribute a lot of what has happened to luck and being in the right place and at the right time and so on and so forth. And so I have a huge responsibility. One of the things, other than writing checks, which is great, and everybody should do that if they're in a position to do so. I started a nonprofit a few years ago, many years ago actually, called Kavod Fund. And the objective of Kavod Fund is to help others through interest-free lending. The idea being, this actually came out of a discussion with a rabbi. And he was telling me if I knew within the Jewish religion what was the highest level of giving. And I said, I know that. It's giving anonymously. It's very simple, right? Where you're not looking for the recognition or reward and so on and so forth. And interestingly, he said, no, it's lending without interest. And I said, Rabbi, you're crazy. How can you tell me that if Kevin is willing to give away his money and Leo is willing to provide a loan without interest, Leo has more merit? And it really shocked me. I couldn't believe it. I'm like, no, you're wrong. Absolutely wrong. And he said, the problem is you don't understand this because you've never been on the receiving end. It's all about how you receive with dignity. And that is more important than whether or not it's repaid. And so it really was something that was very meaningful to me, because you're trying to help people. If you can help in a more dignified way, that would be more valuable, number one. And number two, I have limited resources, and I'm very wealthy next to somebody, but I'm very not wealthy next to somebody else. Mm-hmm. Wealth is relative, right? The reason I feel wealthy is because I'm happy with what I have. But in terms of dollars, it's only relative. There's always going to be someone with more money than you, always, and someone with less money than you. So if I have limited resources and I can lend my money and get it back and lend it again and get it back and lend it again, then if I had $100 or $1,000 or $10 million, the impact is going to be multiplied 10x. So that made sense to me. And, lastly, I said, you know what, why should I limit my impact to my pocket? As I said, it's very little relative to the impact that I want to have in this world. So I've also been given energy and creativity and intelligence and, a variety of things other than money. And so how can I use those to help? And so I created this concept of a website where you can go on and you can find different people who need money for different reasons, and you can lend interest-free. And you don't have to be very wealthy because we're using the model of crowdfunding. So you can lend $18 at a time. So if you find somebody that you connect with, maybe is somebody that is in a similar situation that you were, or you just have a weakness for education or entrepreneurship, or you once had an issue with your credit cards and you're helping this person without interest to consolidate their debts and pay off their credit cards, then I wouldn't be limiting the impact to my own pocket, but I would open this up to more people and make this a great deed available to others, so they can actually do it and experience it. So I'm very proud of that.
Yeah. How's it going? How is that effort going?
Well, it's very tough because you need to create a marketplace. You need to have
Mm,
borrowers and lenders. And I have a very ambitious goal of being a global organization. So I started in the US, Mexico, and Colombia. And we have borrowers in all three countries. And I started like that because I wanted to have the problems, as you're scaling an organization, I knew I wanted to be global. So I'm like, I'd rather have all those issues that are going to come up now when I'm building language, how to transfer money, regulation, and so on and so forth. So it's going well. We've done more than $1 million worth of loans. The
nice.
it's the repayment rate is over 95%, so it is
Wow.
working. There's a lot of nuances. We have transformed a lot of people's lives. I started doing this before the COVID pandemic, but during the COVID pandemic, I remember I was super stressed because I thought we were going to have another 2007, 2008 type of crisis, and in fact, deeper. And, we had a large portfolio with close to maybe $1 billion in loans. And so a lot of obligations. And I was very stressed. And I was able to take a step back and I decided I'm going to do three things. First of all, yes, I'm going to spend 30 to 40% of my day in defense, but not 100% of my day in defense. Then I'm going to spend 25 to 30% of my day in offense. What opportunities are there, right? Not only defending what I have, what opportunities are being made available. And lastly, I'm going to spend a third of my time helping others, because as much as I am in trouble with this crisis, there's people that are worse off than I am, and I'm going to try to help. And so I really stepped up my efforts of Kavod Fund during the pandemic, and we saved a lot of businesses and a lot of people from getting into deeper trouble. So I think that accelerated the project a little bit, and that's basically it. Of course, I am involved in many community projects. I am involved in the Ken Jewish community. I've been involved there for like 15 years. Um, I try to mentor people as well, and I try to be. I see the opportunities to help just like I see a business opportunity. Sometimes you're having a conversation with somebody, and for some random reason, you have an opportunity to help. I think you should seize those opportunities. They're there
Yeah.
for a reason. Yeah. And that's how I view it. So, just like you should for business, being curious, asking a lot of questions will uncover some business opportunities, and it will uncover opportunities to help others with money, with time, with help, with contacts. I think everybody's in a position to help, and you just need to be a little bit more sensitized to it and be aware and see it as an opportunity. And suddenly you say, boom, I see an opportunity. I'm going to help this person. And that leads to other things as well.
Leo, you mentioned the adversity of that first failure being a real challenge to kind of get over and tested you personally, but you also got some good luck. I wonder who might have helped you along the way. Like you were talking about, maybe finding ways you can help, but who's come along in your life and gotten you through some of this stuff?
I think when I failed, I was not ready for success. If you think about it philosophically, you may say it's God. I believe in God. I believe there's something bigger than ourselves. And I believe that I needed that lesson. If you ask me today, I would pay money to get that lesson, right? I think that had I been very successful at that point in time, I would have been a worse person and a worse business person and a worse, spouse and father and everything. I mean, not that I was a bad person, but I just think there's a lot of opportunity for growth.
Well, any key people that have come along, maybe in your early years?
One of my first employees, after doing a few deals on my own on the real estate side, I hired Tommy Norgard. I think you know him well.
I do.
I actually hired him for something else. And I was going to send him to Mexico to do some business. And after I hired him, he told me that he didn't have a visa, that he couldn't leave the country. So I kept him on the real estate side. He had a very strong institutional real estate experience, and he has been one of the key people in helping me grow LLJ Ventures. My family, for example, I remember when I had that failure. I have an uncle who lives in Mexico, and he was actually an investor. He understood what was going on, and he actually took a plane and came and spent an afternoon with me talking. He had a failure himself in his life before, a very significant economic failure, I guess, at one point. I don't know all the details, but he felt compelled, and he came and he gave me moral support, and so that was huge. But I think most importantly, maybe my wife. So I was relatively successful since a young age. I made very good money, and I had never had a failure. So we had a relatively good life, relatively speaking. Not saying I was a super wealthy guy, but we, for the age I had and the situation we had, we were in a comfortable position. And when this failure came, one of the things you start questioning is, what is my spouse gonna think if I can't provide anymore, and this and that and the other. And she was very, very clear and supportive from the beginning. No matter what happens, I am here with you, and whatever I need to do to adjust, to do this, that, the other, I am here for you. And having that rock, having that stability when everything else is unstable, I think is what helps you stand up. If you get shot in one leg and you have the other one on your hands, maybe you can stand up again, right? So having that rock as my spouse was definitely instrumental in me having the confidence of going in again and making a really bold bet, because some people thought I was crazy. You just failed here, and now you're going into the place where nobody wants to go. You need to have a lot of confidence in yourself to do that.
Into the burning building.
Yeah, we were running into the burning building, and I think having a rock and having a good family and good situation where you feel supported allows you to take on that additional risk.
Related to that, just managing success and in your day-to-day, I imagine you guys are inundated with 100,000 opportunities. How do you prioritize things and just get through the day, even if it's as simple as what you said during COVID, where it's 30-40% offense, 30% defense, and 30% give back? Today, how do you manage all the inflow and actually the calendar?
Yes. First of all, have a good team like Tommy.
Yeah.
So he can filter out a lot of the opportunities, and try to have a more systematic way. Even though we're a small company, we're pretty entrepreneurial, and there's a lot of discussions. Let's call them water cooler discussions. We have a structured once in a week meeting for pipeline, and we have a structured once in a week meeting for asset management. And so if there's a new deal that passed certain filters for Tommy and that is congruent with our current strategy, he would present it. We would all listen to it and ask questions, typically go back and ask these 5 things that are critical to us, either wanting to continue or not, or, we're not going to do that deal. But instead of saying we're not going to do that deal, we're not going to do that deal at that price. We would do the deal at this price. And if it's a crazy price and people tell us to go away, then we're okay. I'd rather have that, because in some other instances, we've thrown out really low prices, and in some instances, we've actually gotten it, right? Or you stay close to something, even they say no, you still stay close, and once they understand that, the current offer they have is not real and it blows up, and they see that you were very diligent, even though you had a lower price, they may come back to you. So I think it's a combination of having the right team and having a more structured way of analyzing opportunities and passing on them. It's very important to know how to say no.
Yeah, absolutely. I want to be respectful of your time, Leo, so I'll give you the floor. Any message to entrepreneurs that are, early, mid, or late stage? Just words of encouragement, advice, things you wish you would have learned earlier, whatever you like.
I think, first of all, let's discuss failure. It is difficult to be an entrepreneur, a true entrepreneur, and never fail. I think most incredible entrepreneurs have had failures. When we read, about the one or two entrepreneurs that never had a failure and they're billionaires, and that's not real life. It's a fluke. Even Steve Jobs, had a bunch of failures. So knowing that, then you can see failure as an opportunity for learning. You learn much more from failure than from success. And from success, a lot of the times, what you learn is that you think you learn certain things because you think you start to attribute success to certain elements where they may or may not be the right elements to be attributing the success. You might have been lucky, but you think it was all because of your brilliant strategy or because X or Y. So that's the first thing. If you start looking at failure as something that is part of an entrepreneurial lifestyle, then when you encounter it, first, learn as much as you can. Second, do evaluate what you did wrong. The failure might be 100% because of you, but it might not be 100% because of you. So separate the failure of the business to your personal failure. Personal failure for me is you're a bad person. You disrespect people. You mistreat employees. That's failure, personal failure. Business failure doesn't mean you failed as a person. Also, because as a person, you have optionality. You can fail 20 times and you can be super successful one time and more than compensate. Or you can be successful 5 times and be, and have one failure. That doesn't define who you are, because you can always stand up. If you have health, if you have life, you can redo it again and you can retry. So that brings me to my second point, which is resiliency. You need to have resiliency. Success is never as easy as it seems. It's always a struggle, and you need to be resilient and work very, very hard. If you ask me what's more important, the brilliance or resiliency in being successful in business, I would say resiliency for sure. That's what you need, because when times get tough, you need to continue waking up and making progress forward, even if it's at a small pace. And lastly, I would say, why are you here in the world? I mean, if I think there's a lot of people that do really well in a corporate job, but there's a lot of people that are here for other reasons and really have a shot at transforming something, at innovating something, at creating something. And so if you have that, that idea in your head, I would say try it, because we only live once. Don't let that opportunity go. And later on, it's a little bit more difficult to take risk, maybe when you have a family and when you have more obligations. So I would encourage people to try to be entrepreneurial as early as they can once they're ready.
I love it. Leo, thank you for taking the time. Listeners, thanks for taking the time. Leo, I don't know if you want to throw out the website for LLJs, if somebody could find, I'm sure if they just Google it, they could find it, but
Kevin, thank you for your time and your insightful questions, and more than anything else, for having interest in me and my story. LJ's website is www.ljventures.com. And if you do have any questions, please feel free to send them to Kevin. I will respond to any and all questions you have.
All right. Thanks, Leo. I appreciate your time.
Thank you. Have a wonderful day.